if sustained, can be very negative. It means we're setting up for a bear market. But it can also mean there's uncertainty now.
In today's video, ARK CEO, CIO, Cathie Wood, weighs in on inventory pileups, liability-driven investing, commodity prices, and why she believes that the Fed is making a mistake as they base policy on lagging economic indicators. Wood discusses fiscal policy, monetary policy, market signals, economic indicators, and innovation.
On to economic indicators. They were all over the place, some surprising on the upside, some surprising on the downside. On the upside, capital spending, non-defense capital goods orders, ex-aircraft, big surprise. I think it was up 1.4% on a month-to-month basis, and expectation was not much change at all. We had, as I mentioned before, the JOLTS index. Job openings went from roughly 9.6 million to 10.1 million. That's interesting. And of course, today we got non-farm payrolls, also higher than expected. On the negative side, some of the surprises were University of Michigan Consumer Sentiment Index relapsed. So we're back into deep COVID and 08-09 territory in terms of the sentiment index. And it makes sense. It's that regional bank crisis. It's consumers saying, wait a minute, what's going on? Are we safe? Are we safe in our banks? That's a big one, right? And it was a big drop and a big surprise. The other thing in that report was consumers saying, I think inflation's going up. And I think one of the reasons for that was gasoline prices did go up. And the consumer is railing against price increases. And that's why we think a lot of companies are going to start cutting prices. Home Depot said it was going to start cutting prices in some categories. And Costco, which disappointed on a same-store sales front, it too said something happened in March, April. Many companies are saying this, and we're going to cut prices to draw the consumer back in. We also got the ISM New Orders Index. So this is on the manufacturing side. It dropped to 42. This is recession territory for manufacturing. And that's a pretty fresh number. On the good news on inflation, in terms of reported inflation, the PPI was less than expected at 0.2% month to month, which took it down to 2.3% from 2.7% on a year-over-year basis. And we think it is about to flip into negative territory because commodity prices, as measured by the Bloomberg Commodity Index, are down about 29% on a year-over-year basis. So that's the pipeline for the PPI, and the PPI, of course, is a pipeline for the CPI, at least in part. Now on to market indicators. I mentioned earlier the equity market has narrowed in terms of just a few stocks, the mega cap tech stocks, accounting for, I think, at 75% of the market's move this year, the positive move this year. We would expect, if we're right on our inflation and interest rate call, the market to broaden out. And that will give us more comfort. Narrowing tends to be, if sustained, can be very negative. It means we're setting up for a bear market. But it can also mean there's uncertainty now, in this case about inflation and interest rates, and when there's more certainty that those are under control and moving in the right direction, then we think the move will to broaden out. On the fixed income front, we did go up in terms of the 10-year Treasury yield from about 3.5 to 3.7 in the last month. And I think some of the reason for that is the debt deal. The Treasury has not been issuing debt because it had hit up against the debt ceiling. And it was doing all kinds of fancy maneuvers around cash management to make sure that the government could still pay its bills. Well, now it can issue again, and so the entire curve has moved up. And I think with today's employment report, again, superficially, the headline numbers, the market's basically saying, okay, the Fed could raise now. Maybe they pause this time, but they'll probably raise a couple of more times after that. We're paying very close attention to this 4.3%, which is where the Treasury bond yield peaked in October. And from 3.7, we'd be very surprised to see it go back to that level, especially if we're right on what's about to happen to inflation. Also in the fixed income markets, the yield curve, the regional bank crisis with the Fed coming through with the bank facility and shoring up the regional banking system with the lending facility. With that move, the yield curve, the inversion diminished to some extent. It got to something like 110 or 115 basis points, meaning that long-term Treasury bond yields were 1.1 percentage point below short-term, 2-year yields. Then it narrowed to 30 to 40 basis points, and now we're back today to 80 basis points. And that's the bond market talking, saying, wait a minute, the Fed should not be tightening in here because the bond market, in its wisdom, is looking perhaps at a hard landing, but certainly lower than expected inflation and growth. That said, we also are paying attention to credit default swaps, which they're somewhat elevated, but they seem to have settled in. Those are bets or insurance policies against a default. As I said, the price of those is a bit elevated, but is not shooting out here. And the spread in terms of corporate bond yields relative to Treasury bond yields, again, a little elevated, but nothing alarming. So the yield curve is flashing a yellow light, I would say. And if we go back to that minus 115 basis points, then we think we may see another crack in the system, whether it's regional banks or commercial real estate. We're certainly seeing strategic defaults as a problem for some companies out there. On commodity prices, another market indicator, I mentioned they're down 29% using the Bloomberg Commodity Price Index. All commodities are down on a year-over-year basis, the ones that we monitor, except for gold and silver. Gold has been in a trading range for the last 2.5 years now, and as long as it stays in that trading range, we're fine. I think part of the reason it's moved up from the 16, 17,000 or $100 range up to the $1,900 to $2,000 range was the flight to safety. Some would say it's fear of inflation, a hedge against inflation. We would say it's more of a flight to safety, much like Bitcoin enjoyed going from 19,000 to 30,000. Oil prices have been very interesting. OPEC had said that they were going to cut back by 500,000 barrels a day in May, and yet the oil price rallied a little bit on the announcement, but in the month of May, has come straight down from the high 70s to the low 70s. It broke into the 60s for a moment there. And we do believe this is demand destruction at work because of electric vehicles and electric vehicle miles traveled. Now that Uber is renting cars, and Hertz actually is renting cars or is buying cars electric vehicles because the maintenance costs are 50 to 60% lower than that for gas-powered vehicles. The dollar, against all expectations, has moved up in the month of May, and that's interesting. It may be because we did not have the debt default, so maybe another relief rally there. But whatever it is, it's anti-inflationary. A rise in the dollar, all other things equal, brings inflation down in the U.S. relative to other countries. So I'll end by saying, or echoing what I said the last time. We have found it very interesting that Bitcoin and crypto generally rallied in the face of a crisis, the regional bank crisis. And that was proof positive to us, at least, that crypto, and especially Bitcoin and to some extent Ether, have become flight to safety vehicles, much like gold. And in fact, it got us thinking about innovation generally, especially now that AI is becoming so important, top of mind, all corporations now, which means it's going to happen faster than otherwise would have been the case. We think innovation is going to be perceived broadly before all is said and done in this cycle as a flight to safety. It's the opposite of the way investors and others have been perceiving it in the last couple of years. They were looking at innovation in a period when interest rates were going up as a problem in their portfolios, because innovation or any long duration asset is very dependent on interest rates. But if interest rates are going down, then they turn from a headwind into a tailwind, so that's good. But this other notion of flight to safety, if and especially in the world of artificial intelligence, if my competitor is doing something in the innovation space, specifically AI, that I am not doing, and I am going to lose, then I need to get there quickly. This is a safety valve for me to innovate at least as fast, if not faster, than my competitors. And AI certainly is bringing that risk and that opportunity to life in a way that we couldn't have imagined in 2014 when we were doing our work on NVIDIA and who else might be the beneficiaries of this very powerful movement.